For more on the markets, we're joined right now by Mandy Xu. She is Chief Equity Derivatives Strategist at Credit Suisse, and Sarat Sethi, who is Managing Partner and Portfolio Manager at Douglas C. Lane & Associates. Sarat, by the way, is also a CNBC contributor. And folks, let's just talk about where the markets stand right now and where we've been expecting them to be. CNBC took a look at 17 strategists and what their equity calls were for the full year. And of those 17, 14 of them have numbers that's below where the market is right now for the year. 14 of them have numbers that are below.
Can't believe that.
We've got almost 2 months left. So does that mean...
The experts?
Yeah, the experts. Does that mean stocks come down from here to meet their expectations, or does that mean these strategists are going to have to raise their numbers? What do you think, Scott?
Well, I think this is all going to be predicated on kind of the trade talk. That's going to be really important. If things go as planned and there is actually an agreement, I think they're going to have to raise their numbers, because a lot of what's not built in is earnings that could actually change on the upside because of all the kind of costs that we are all expecting that will probably get taken away. And then you get some revenue upside on it, too. So I think today, when you look at the market, it's pretty fairly valued. And if you look at certain sectors like financials, industrials, healthcare, they're cheaper than the market. And that's kind of where the opportunity is. Yes, tech is doing well, but the tech that have real earnings, real cash flow are doing well. So I think the market's bifurcating and saying, look, there's value out there, and I think that's kind of a little rotation, and then momentum is on the companies that are actually doing well and that will continue to do well.
We'll talk about some of the stocks that you like in just a moment, but Mandy, just overall, what do you think the direction of the market is as we head into the end of the year?
Sure, I can tell you in the option market, the positioning is turned very, very constructive, especially into year end. So, and it's actually a very sharp turn, because a month ago when I was on the show, I was talking about there's a lot of demand for hedges. Everyone's very cautious, to the degree that, if historically, when you see that much of pessimism in the options market, it actually risks to the upside. And that's exactly what we saw over the past month. Now what we're seeing is complete opposite. So demand for upside calls in the option market went from a one-year low at the beginning of October to now a one-year high. And most of these bullish bets are concentrated into year end. So people are certainly playing for a continuation of this rally.
So that's where the momentum's headed.
Certainly.
What do you think's driving it?
I think part of it is fundamentally driven, right? So stabilization in economic data, earnings coming in better than feared, trade deal making progress there. But part of it, I think, is also positioning driven, because everyone has been so defensively positioned across hedge funds, across retail. Every client base has been so defensive, right? You talked about the strategy.
We were expecting recession potentially to hit us. And
exactly. So I think no one was positioned for the upside, and therefore they're getting squeezed on the upside. So on our Prime platform, what we're seeing is a lot of short covering, right, over the past month. Not surprisingly, as the market makes new highs. So I think positioning is part of it, but I do think, the majority of it is fundamentally driven.
Why don't I just go home if we're up 22% and just take everything off the table? We're getting bullish. That's usually a contrarian indicator.
Yeah.
Would you recommend people doing that?
So the S&P is up 22%.
Most 18 on the Dow.
Yeah. Most clients are not. So hedge fund average return for, whether you're looking at macro, equity, long, short, et cetera, average hedge fund return, high singles, low double digits.
So they're not going to even meet the S&P?
They're trailing significantly. And that's what I'm saying. Like, going into year end, if this rally continues, you're going to see upside chasing from that investor base.
And you will see people actually selling down, because there's still a lot of nervousness in this market. So those who have made the 22%, 25% said, I'm going to, it's meeting investor objectives. And I think most professional managers will say, when I've hit my targets or I've hit my clients' objectives, I'll take money off the table. And I think, so you'll see one side is institutions now chasing this rally into year end because they don't want to be out of it. And then you'll see individuals kind of saying, hey, maybe I'll take some money.
Is that 17? Is that a mix of sell side and buy side?
It's the 17 that CNBC follows, 17 forecasters they follow. I'm not sure who they are.
Whether they're buy side or sell side.
I can look into it, find a little more information.
So it's so much better to be sell side. It's like,
Well, there's not much downside. You just say you're wrong.
Well, that's what I mean.
But when you're on our side
they aren't any less shy about giving
your clients will come after you and say, why?
No, they don't. They come after their brokers. And then the guy just goes and moves to another firm and starts, talking out of both sides of his mouth there, usually. But I'm surprised we got him on
17
on
of them that we track. Yeah,
14 are wrong.
Yeah. 14 are now below, their price targets are below where the S&P is. Yeah, they're wrong. Yes. If you want to put a fine point on it, they're wrong.
Well, they're not.
They're not right.
They're not bullish enough, obviously.
Right. Well, you've still got, 7 weeks left on the end of the year?
We could be at 2,500. That's what they. But then they'll say.
Right? At this point last year, you had the Fed kind of raising rates, and then you had this big market sell-off. So people are still fearful of that.
Let's talk about this weird construct of everybody chasing this idea that they have to beat the markets by the end of the year, which is why you're going to see this momentum potentially moving all the way towards the end of the year. What happens January 1st when everybody resets the clock on this dumb, construct of a window that we've set up?
Then I think earnings are going to drive the market again. So right now you might just see more of this momentum. And at that point, I mean, the S&P today 17 times earnings. If you do get 18 times, then you will see kind of a little pullback, I think.
So to that point, I say there's a very interesting bifurcation in the option market. I talk about the bullish sentiment, and that's very much going into year end. We are still seeing hedging. So it's not that people are not hedging. They're just hedging further out in terms of maturity. So to your point, there's still a lot of longer term risks, right? Whether it's talking about recession risk, trade deal, whether it's earnings, and of course with the election coming up next year. So there's still a lot of longer term risks out there, and that's what we're seeing hedging just going into year end. There's a little bit of a squeeze going on.
Sarat, what are some of the names that you do like? What are your favorites?
So in the financials, which I think are the most undervalued, I like JP Morgan. I think Morgan Stanley's a really good buy. Morgan Stanley by itself is trading a little bit over book value. Great dividend and moving to wealth management. Blackstone, I think, is a place a lot of people are investing in as an owner of that stock. I think you want to be there. United Health that we mentioned on the healthcare side. And then some of the multinationals, the blue chip multinationals like Honeywell, like Microsoft. I think you're not going to go wrong owning those companies, especially if you see global growth coming back.
What do we need to watch for? What are the risks that you kind of have out there on the table? I guess trade war is front and center. That's number one.
Yeah, I think certainly, if the manufacturing weakness spills into the consumer sector, I think you're going to see a resurgence of the recession fears, recession talk. On the upside, I would keep an eye on Europe, right, and the potential for fiscal stimulus there. It's very much a tail risk, but there are some political catalysts coming up in Germany that I would watch for if we get a change in the governing coalition there. And we see a coalition with the Green Party, which is very much pro-stimulus, pro-government spending. That could be a big tailwind for that region.
And there's zero option to that right now because this has happened so often in Europe. We've had so many years. But if that does happen, and hence the multinational exposure, because corporates that have global exposure are going to do well for that.